Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we'll have a look at the latest with regards to financial markets and what's happening in Iran. We'll have a look at the non-farm payrolls in the US, and then also we'll have a look at the change in interest rate trajectory in South Africa. We're going to start off with Iran. As we mentioned last week, there's two key areas to monitor as it relates to the global economy. Firstly, there's a lot of energy infrastructure around the Persian Gulf, and secondly, the Strait of Hormuz is a key choke point for global energy. Now, as things stand at the moment, and we're tracking the number of ships going through the strait has in effect been closed. There's a variety of attempts underway to try and ensure that energy transits still continue through the strait. But as things stand at the moment, over the past 7 days, we've seen an average of just one tanker per day going through the strait. So in effect, it is shut, and the net consequence of that is that we've seen a sizable surge in energy prices, and Brent in particular. As of recording, Brent at the moment is trading at $115 per barrel. We've seen a pretty sizable surge. And we know what typically happens when that occurs. We'll end up with knock-on consequences for global inflation. And as a result, we'll end up with knock-on consequences for interest rates. And as a result of that, we've seen a sizable pullback in markets. Now, these charts relate to market performance up until Friday's close. And already we can see that today we're going to see further downside to markets across the globe. But nonetheless, let's just have a look at what's happened until Friday. We've seen a pullback since the bombing started in global equities and US equities. US down around about 2% to Friday's close. Global equities down a little bit more, down to around about minus 3%. And we've seen this broad underperformance of rest of world equities relative to the US. And it does highlight how, in a relative sense, the US is more insulated against the surge in oil and energy prices than other places like, for instance, Europe. Interestingly, the dollar's been about flat, though. Typically, up until now, or up until pre-Liberation Day, the dollar would have acted like a safe haven currency, and we would have seen quite material dollar strength in an environment with the sort of uncertainty that we're seeing now. And it hasn't quite come through, certainly not yet. And similarly with US Treasuries would have been the globe's safe haven asset. In an environment like this one, would have hoped they actually would have been up. But up until Friday's close, they've been down. And in the interim, as mentioned before, we've seen the surge in oil prices. As it relates to today, we're likely to see quite a bit of red across markets. The S&P futures at the time of recording is down about 2% or so. And we've seen bigger moves than that in Asia already. So it is going to be a day where we see quite weak returns or negative returns pretty much across the globe. And the key question for us is, when do we increase our risk allocation? We have been defensively positioned for some time, and now we're seeing that markets are pulling back. And I think in order to answer that, we need to try and get a handle of when the Strait of Hormuz is likely to open. That's unlikely to be soon. And when are we likely to see a change in the trajectory for the oil price? And again, it's probably worth waiting a little bit. We have set up a global investment strategy group meeting, our internal group which reviews our risk allocations. That's set for Thursday. And the purpose of that meeting is to decide whether we should increase our risk allocation across the globe or wait. And we'll give feedback on that next week. In the interim, we are seeing prices surge at the pump in the US. Gasoline prices are already up. There will be increasing pressure on the White House to try and find ways to get energy prices and oil prices in particular down in the US. And it is going to be a difficult task given all the energy infrastructure and the choke point that is the Strait of Hormuz. It's not just energy prices, though. Agricultural prices are ticking up too. There's likely to be a reduced output of fertilizer across the globe because one of the inputs comes from the Persian Gulf, and in an environment of restricted supply, we're likely to see a surge in prices. So it's a bit of a repeat of what happened when Russia invaded Ukraine, seeing higher gas prices, we're seeing higher fuel prices in general, and likely higher agricultural prices too. The net consequence of that is that, as mentioned at the beginning, we are likely to see an increase in inflation, and that means that cuts are off the table for now. They may well be on the table again at some point soon, but only in the event that there's a material slowdown in economic growth. And on that note, it's worth just talking about what happened with regards to the non-farm payrolls print on Friday. It was a pretty bad miss. The non-farm payrolls numbers for February were down 90,000. The consensus was that it would be up 50,000. And in addition to that, the prior 2 months were revised down as well. So the labor data is painting a picture where the US economy is slowing down and was slowing down just ahead of the bombing of Iran. If we look at some longer-term numbers, the 3-month average, which is the best gauge of the labor market in the US because the monthly numbers are so volatile, the 3-month average is sitting at about 0. In fact, there have been no jobs added since April last year, around Liberation Day. We can see that there was a trend increase in employment prior to that, and that's now leveled off. You can't say definitively that that's due to the tariffs, but it would appear that the intention of the tariffs to increase employment in the US has not been successful. Year-on-year growth for employment in the US is just around about 0.1%, which is what you would typically see in an environment that the US economy is slowing. And in fact, if you look at tracking employment has been in decline for some time, which is just another steer that something is not well with the US economy. It is worth emphasizing that the unemployment rate in the US is at this point still low. It's just a bit above 4%. And we haven't seen the sort of spike that we have seen before in material slowdowns in economic activity. So it's not the case definitively that the US has slowed. It's more that it was looking like it was slowing. And now what's been added to that is a surge in energy prices, and the central bank is now somewhat constrained in its ability to provide support. And through that lens, it's quite understandable why there's been a sizable pullback in US equities today, and why there's been a pullback since the bombing started. And again, the key question for us is, when do we see things start to turn? And that will be the key talking point in our feedback next week. And finally, on to SA. South Africa is clearly not immune to what's happening globally. Already at the end of February, we had seen a year-on-year increase in the price of Brent in ZAR, and now in March, it's going to be up much more than that. So we should pencil in quite sizable fuel price increases, and in turn, that's likely to rule out the SARB cutting rates anytime soon. The forward rate agreement, which is a forward-looking estimate of where the SARB was likely to go, that chart has shifted quite materially. The market was pricing in rate cuts by the end of this year over the past couple of months, and as of this morning, the market is pricing in no rate cuts over the coming 12 months and then a potential increase. Now, these lines will move around quite a bit as a result of oil price volatility, but in effect, we need to see the oil price start to come down quite soon for the SARB to have space to cut within the next 6 months, and as things stand, that seems quite unlikely, and we'll talk a bit more about that next week too. That's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity derivatives, currency derivatives, bond derivatives, and interest rate derivatives markets, an authorized financial services provider and a registered credit provider.